Allow me to explain exactly what I think is wrong with the trading industry nowadays. Everyone is so vague. They say stuff like, if you see it, you can't unsee it. Stuff like that. Like, what do you even mean? Define seeing it. What is it? Define it. And that is exactly what is wrong. People love to figure out an algorithm. People love to get tricked and stay focused on figuring out an algorithm. Again, you know what I say. I always say, are you here to figure out an algorithm or are you here to make money? And that's exactly why I created the money-making team in the first place. Because a lot of people tend to lose the objective of why they came into trading in the first place. It was to make money and of course to have freedom. And freedom and money, they are pretty correlated, I could say. They go hand in hand. So what do I mean with vague? And how can we not be vague? We need to define things. So we need to objectively look at certain things. And how can we make this objective? How can we define it? Quantifiable. How can we look at something and know, all right, this is a breaker, this is a dealing range, this is an order block, this is my trading setup, this is my entry pattern. That is what the trading industry is missing. It's vague, it's this algorithm, it's this weird obsession with an algorithm. The reason I say that and the reason I go on this little rant, it's very important for you to hear. And the reason I want you to hear that is because now you need to pay attention. Throughout the A to Z guide, I've mentioned it before, everything I do is very much definable. We can objectify a lot of things. It's a lot of step-by-step manner. And that's exactly how I operate. So in this video especially, I will show you how to trade with dealing ranges. I will show you exactly how to incorporate them into your trading plan, because that's also what a lot of people are missing in the trading industry. They show you concepts, but they don't tell you how to incorporate them because they don't actually know how to themselves. The most important rant of your life right there. Let's get into the topic. So dealing ranges, what exactly is a dealing range? How can we objectify this dealing range? A dealing range is a range that took out buy side liquidity and then it took out sell side, or vice versa. It took out sell side liquidity and then buy side liquidity. What exactly is buy side liquidity again? Buy side liquidity is liquidity above the market. So if we have current market price right here, then everything above it right here, this is buy side liquidity. Everything below it is sell side liquidity right there. Now we can define it even more because buy side liquidity and sell side liquidity is still very vague, right? How can we define it even more? Buy side liquidity is swing highs. Sell side liquidity is swing lows. So these swing highs, that is exactly buy side liquidity. These swing lows right there, that is your sell side liquidity. So what we just mentioned was a dealing range is a range that took out buy side liquidity and then took out sell side liquidity. So for example, right here we have this range. Let me mark it with my Fibonacci right here. This is a range, right? Is it a dealing range though? It took out buy side liquidity to the left because it took out swing highs, right? Did it take out sell side liquidity? No, it didn't. So it's not a dealing range. This right here took out buy side liquidity, this candle, and we took out sell side liquidity. Is that a dealing range? Yes, it is. So in this case, what would you do? You would mark out the buy side liquidity right there that it took out and the sell side liquidity right there. And this exact thing is your dealing range. Buy side liquidity taken, sell side liquidity taken. You could make the argument that it's somewhat of a breaker, but I will show you how it is very useful, that dealing range, in a trading plan. So that is our first dealing range. Now, what do we see next? When we continue lower, what happens here? Is this a dealing range? This high to that low? No, it's not a dealing range. But what happens after? We sweep that swing high right there. This one right there. And then what is the next sell side liquidity that we are taking? We first off have this already because that is obviously a swing low. So we have objectified it. That is a first dealing range that we have right there. Then the second, the bigger one, we could argue, all right, we also have this bigger dealing range where we have this buy side liquidity and that sell side liquidity. That is another dealing range. And what happens after? Right here, we also have a new dealing range. Can you spot this one? Also a dealing range. What happens after? We also have a new dealing range right there. Buy side liquidity taken, sell side liquidity taken. Again, defining, objectifying buy side liquidity, swing highs, objectifying sell side liquidity, swing lows. But leading up to those bearish dealing ranges we had right there, we also have bullish dealing range to work with. So what can we see right here? What happened? We take out sell side liquidity right there. Again, sell side liquidity, swing lows or one swing low, can also be one swing low. Then afterwards, we take out buy side liquidity. Buy side liquidity, swing highs. Right here, your swing high. Right there, your swing lows. Sell side liquidity, buy side liquidity. After that, we move back into the dealing range right there, and then we continue higher. Is this a dealing range? Right here? No, it's not. Why? Because it didn't take sell side liquidity. Now, does it mean that just because this isn't a dealing range that it won't hold? No, absolutely not. That doesn't mean, that's not what I'm implying here. I'm just showing you how you can get to a mechanical trading plan using dealing ranges if you prefer that. Again, reminder, the A to Z guide here is to show you options of what you could use, and you can form your own trading plan using this. So if you love dealing ranges and you find dealing ranges very easy to spot, that is exactly what you want to be using. So right here, we have a new dealing range, right? We took out sell side liquidity right there, and we took out buy side liquidity, right? Perfect. We have somewhat of a new dealing range. Then the dealing range fills. Now, you could incorporate a new thing. What if we add the rule? The dealing range has to have a bullish fair value gap. For a bullish dealing range, we have to have a bullish fair value gap. All right, perfect. Let's take a look. So right here, we have a new dealing range. Took out sell side liquidity. Then here, we took out buy side liquidity. And we have a fair value gap sitting right there. Perfect. That is our dealing range with that sell side liquidity right there. All right, and we follow price, and then eventually we reach that drawn liquidity right there. So I think you get the idea of what a dealing range now is. Now, let's look at how we can implement this into our trading plan and how we can actually use it in an objective way. Now, first off, I need you to understand that this is also applicable to every market. So I'm currently showing you Forex, but it will also work on indices. Allow me to show you the best way of using dealing ranges, in my opinion. Right here, we are expanding lower on the daily time frame right there, right? We are coming into that daily fair value gap right there with a previous day high sweep right there. If we now go into the 15-minute time frame, once we reach that daily fair value gap, that is exactly when we want to look for 15-minute dealing ranges. The thing I'm saying here to you is you need context behind your trade. And this is also a very vague, subjective topic that a lot of people talk about. Yes, you need narrative, you need context. What is narrative? What is context? Define it. It is not quantifiable. A lot of people just throw out words into the world. Like, define it. It doesn't make sense. And if someone is not able to define it, then just know they likely don't have a clue what they're talking about. So allow me to define context, define narrative for you. Narrative and context starts on the higher time frame. The narrative you are seeing here is that we are coming from that daily fair value gap. When we are moving from a daily fair value gap, in this case, a premium array, the price will now seek a new discount array because price moves from premium to discount and from discount to premium. A premium array, what is a premium array? We have this daily fair value gap right there, and we have this previous day high. But the most important part is that daily fair value gap right there. That is a premium array. Where's the first discount array? The first discount array is right here. So this gives us our context, our narrative. In between this premium array and in between that discount array, this little area right there, that is where we want to look for 15-minute dealing ranges. So this gives us our context based on the higher time frame. The narrative on the higher time frame is right there. It's moving from premium array to discount array. So there is context, there's narrative behind it. So we don't get lost on the lower time frame trying to trade every single 15-minute dealing range. That is not what we want to do. So if we dive back into the 15-minute, we now have context behind what we're doing. We have a narrative behind what we're doing. The 15-minute doesn't create our narrative. The 15-minute is just to get in sync with the higher time frame context, with the higher time frame narrative. So we already have a place where we want to look for trades, and we already have a place where we want to target. This is our target right there. That daily swing low right there. What is the next step? The next step is we are only trading dealing ranges. So we only look at trading dealing ranges, 15-minute dealing ranges right here, until we reach that drawn liquidity. Then we stop looking at dealing ranges. If we zoom in a little bit right here, what do we see? Coming into that daily fair value gap, we sweep buy side liquidity right there. And right here, we already sweep sell side liquidity. Even a little bit higher, you could say. You could, of course, also say, all right, I take the bigger dealing range. So I take this dealing range. Now, let me first show you the smaller dealing range right here. What we can see here and what we want to do is we want to enter at the low of that dealing range. Of course, if it's a bearish dealing range. So right here, that could be an entry. With a fair value gap as well, that is a perfect entry right there. What would you do? You place your stop above the dealing range and you target the target we had established on the daily time frame. That is the first option. The next option is taking the bigger dealing range, a little bit more certainty. Maybe you are a person that wants a little bit more certainty. Perfectly fine. Then we wait a little bit longer. Right here, the first thing we can see is we now break that low of the dealing range. So we have taken sell side liquidity. So there is a dealing range in the first place. Then again, we enter on the low of that dealing range. Where do we place our stop loss? Above the dealing range high right there. Where do we target? We target that opposing daily discount array right there. All right, that is the second option. What is the third option? The third option, could you see from an objective standpoint, again, could you see this as a dealing range right here? This small little thing as a dealing range right there. That range. Yes, you could, of course, see that as a dealing range. Now, what then happens is if we already moved this low, would you execute on a small dealing range like that? I personally wouldn't, but I do agree. I just talked about it being very vague. So if we make it objective, let's say we took a loss right there. So we took two winners and we took a loss right there. All right, perfect. Then we wait for the next dealing range. What is the next dealing range? We took buy side liquidity here, and afterwards we took sell side liquidity right there. This is our next dealing range. So we want to execute on that dealing range low right there. The low is a little bit lower, the wick right there. Cover what? Our stop loss is going above the dealing range high, targeting what? That opposing daily discount array right there. That is using dealing ranges, how you can get to a trading plan. So let's take a look at another example. All right, so here we are on EU on the daily time frame again. What is the first thing we need to establish? We need to establish context and narrative. What is the context? What is the narrative? Well, we already have a bigger dealing range right here on the daily time frame actually. That's pretty funny because then we have a fractal dealing range right here. Then the thing I've marked up right here is a weekly fair value gap. This dealing range, what can it do? It can deliver into that weekly fair value gap. Because of course, the weekly fair value gap will be a very strong magnet. It's pulling price towards that weekly fair value gap. In this case, we also have a BPR right there, a very small BPR. Let's just take the whole fair value gap right there. Now, again, we dive into the 15-minute and look at our dealing ranges. We haven't tapped into the daily fair value gap yet, so there isn't any reason to look for dealing ranges just yet. There we tap into the daily fair value gap. Now my eyes are going and my eyes are scouting for a dealing range. Was there a dealing range right here? You could potentially say there was. We swept this swing high, but we didn't sweep this swing high. We swept this swing high and then we swept this swing low. Let's just take the trade. Let's take the trade right there because I want to show you the reality of trading because these type of losses might happen to you. And the thing is, there is a losing curve in your trading. This is what I tell the mentorship all the time. The mentorship knows there is a losing curve in trading. And the losing curve is where you first lose when you apply a new trading plan. You first start losing. Then, once you get that experience, you see a couple of losses. You are now likely a break-even trader. Then when you gain even more experience, you start to taste the wins. That is when you slowly start getting those profits. That is a losing curve. So you first start off losing, then break even, and then a winning trader. But a lot of people don't get through the losing cycle. They are always stuck in that first part of that losing curve where they lose. And then what do? They start strategy hopping, strat hopping, shiny object syndrome traders, SOS traders. Or the even more dangerous part is, I would say, where they first pass a challenge using a new trading plan, a new trading strategy, but they have only encountered wins. They haven't had the losing part of that losing curve. That losing part of the losing curve, that drawdown period, it's going to happen. It is going to happen. I can tell you straight up front, it's going to happen. When you trade a new trading plan, you will go through a losing phase. That first losing phase will determine if you are an SOS trader or not, if you now start strat hopping or not. So some people get funded using a trading plan, but they haven't gone through the mandatory losing stage just yet. So what happens? They are now funded. They start losing and they think, hey, I shouldn't be losing. Trading is not about losing, right? Who loses? Who's a loser? You're a loser? No. I'm not a loser. The market is not random. We need to have a 100% win rate. This is very dangerous because when that happens, when you have these kind of thoughts, you will now look at a new trading plan and you will have this endless cycle and you never get out of the losing stage and you lose your funded account because you don't understand risk management. You don't understand sticking to one thing. You don't have your psychology in check. All things we are going to go over later on in the A to Z guide. So right here, this could be a loss. All right, perfect. What do we see afterwards? We continue. We do have some kind of new dealing range right there. Let's take it. Right there. Targeting the opposing daily discount, which was that swing low right there, combined with a weekly fair value gap. All right, we take another loss. -2. Remember that, -2. All right, it seems like we might have a new dealing range to work with right here. This is the low, the sell side liquidity. This is the buy side liquidity that we took right there. Right there, we have a dealing range. Cover the dealing range high. Target that weekly fair value gap, aka that swing low on the daily time frame right there. We are tagged in right there. Perfect. We continue lower. Then right there, we have a new dealing range. Let's look at this. We have a new dealing range. Let's just execute right here. We execute right there. We have this new dealing range right there. And we target the lows again right there. All right, we took another loss. So that is -3 right here. We do have one trade still running right there. There we have a new dealing range. Now we have two dealing ranges actually. We have this small dealing range, which you might have missed the trade actually right here. You might have missed it right there. But we also have this bigger dealing range right there. So exactly there, it's another trade. Covering what? Covering the dealing range high right there. Targeting what? Targeting that daily discount array. All right, do we get another dealing range? All right, here we have another huge dealing range actually right there. We have another huge dealing range. This huge dealing range that we have right here. We again have that low right there. This could be an entry, right? But the thing I do want to say right here, covering those highs, targeting again the same target right there. This is 0.6 RR. Is that worth it? No. At least a minimum of 1-to-1 RR, I would say, is worth it. Right here, this is not worth it. So that invalidates the ID. I wouldn't take that. And we continue lower, we continue lower right there. There we have a new dealing range. Targeting the same lows. All right, right there. We got taken out. Perfect. So we have a new dealing range here as well. We have buy side liquidity right there taken. Sell side liquidity right there taken. There it gets tapped in right there. Covering the highs. Targeting the lows. And right there, this take profit gets hit. This take profit gets hit. This take profit gets hit. So let's actually count this. 3.2, 3.49, and 2.57. That is 9.26. If we, of course, subtract the losses from there. So we took one loss right there. We took another loss right there. We took about 2 losses right there. So that is around -4. But if I missed a loss, let's say we are -5. All right, so in these 3 days, we are -5. But, don't focus on the negative. We are plus 9.26. That is plus 4.26 for a stupidly simple trading plan. And we haven't even incorporated anything else just yet. This was just dealing ranges and daily delivery, you could say. Daily premium to daily discount to daily premium. That's the only thing we incorporated here. Now, imagine if we paid attention to kill zones, if we paid attention to market structure, if we paid attention to order flow. Order flow is what I go very in depth on inside the mentorship. And I can already tell you, applying these things, this loss right here would have been avoided using the kill zones already. That is a -1 avoided. These losses right there would have been avoided using order flow. This would have been one of the very few losses. So that brings us to a new end total. Applying confluences and applying other things besides just the dealing ranges and the premium to discount to premium, we would come to a total of 8.26 for this single week. Now, let me remind you, you are now outperforming every single hedge fund in the world if you can keep this up consistently. So the thing I wanted to show you here was that this trading industry is first off very vague. People can't define a lot of things. They can't seem to objectify it, can't seem to simplify it. This simple dealing range strategy, you can already tell it is profitable. This on its own can be profitable. Now imagine if you only start using kill zones. You only trade kill zones. That takes away a lot of losses. And the next thing is if you use the other concepts, some other concepts, you don't need to use everything. You just use the kill zones and some market structure and using the higher time frame, zooming out, zooming in. You just use those concepts. Combine it with dealing ranges. Just using dealing ranges as your entry pattern, for example, and that is literally all you need. Again, I don't want you to trade this trading plan. First, have an idea of all the concepts that we are using. First, have an idea of kill zones, etc. You need to first study a lot. Don't think that I just gave you the holy grail and you are now ready to go out there and trade. No, not financial advice or anything. Don't trade this trading plan, please. First, study it. Study it a lot. Now, if you want more information and if you truly like this, then you will like the mentorship that we have. First link in the description. And if you like this, then you will be absolutely mind blown with what we teach inside the mentorship. Again, if you are interested, you can take a look at that. First link in the description. All right. Thank you. Thank you for staying to the end. And I'll see you at the next one. Thank you.